Hello again. Happy Tuesday, and thanks for watching. So, sales are down, prices are down, housing starts are down, real estate stocks are down, and there's a storm brewing, especially in my background. But don't worry, things are going to be looking up because you're watching this channel. Let's get started with some CMHC data for the month of June. So, this was a recent post on X. According to CMHC, housing starts are expected to drop for the rest of 2024. High interest rates and weak condo pre-sales will continue to slow multi-unit construction in major centers where it takes longer to get apartment projects off the ground. Let's look at the June data. And they added three charts for us to look at. So the first is month over month seasonally adjusted annual rate trend. The total monthly seasonally adjusted annual rate SAAR of housing starts for June 2024 decreased by 9% compared to May, dropping from 264,000 units to 241,000 units. And of course, it makes sense. Land's more expensive, building costs and permitting is more expensive, cost of borrowing is more expensive. Who wants to build homes? Nobody wants to build homes. So here's the housing starts in Canada year over year trend, and this is just for the month of June, not a seasonally adjusted yearly one. In urban centers, the actual housing starts fell by 13% in June 2024 compared to the same month last year. Multi-unit starts were down 16%, while single detached starts remained steady. And you can see there 23,500 units last year were started, and this year it's only 20,500. And they saved the best for last or the worst for last, depending on how you're looking at this. Notably, Toronto and Vancouver saw significant declines in multi-unit construction in June compared to June 2023, with starts dropping by 60% and 55% respectively. On the other hand, Montreal saw a remarkable increase of 226% in housing starts. So this data is just the multi-unit starts, which is a big portion now of the Canadian inventory. And looking at Toronto first, huge drop. Again, it's just so expensive to build. It's just not happening. Same with Vancouver's. Vancouver's is ridiculously expensive. And of course, their starts are way down, over 50%, 55%, and 60%. Now, Montreal. Why is Montreal doing so well? They're up 226%. My reasoning is they got $350,000 per unit from the Housing Accelerator Fund, which Montreal and Quebec matched, mind you. So they have 350 from the Housing Accelerator Fund and 350 from the province. So of course they have enough money to build these units, whereas the rest of Canada got $35,000. That's about enough to pay admins to stop building from happening, and this is what's happening in the rest of Canada. But again, I don't know why Quebec and Montreal came up with such a good deal, and the government, of course, they signed on, giving them 10 times more than each of the other cities in Canada. I'd really like to know the reasoning behind that. All they'll say is, well, Quebec matched us. Well, of course, I'll match you. You give me 350,000, I'll put in the other 350 and I'll build a nice little house here in Niagara, and I'm sure many other people would too. Anyway, let's move on to the CREA stats for the month of June, the national statistics, and here's what they had to say. Canadian housing activity perks up in June. Wait, didn't I just say sales and prices were down? Anyway, let's keep reading quickly here. Activity in Canada's June housing market saw some early signs of renewed life in June 2024, following the Bank of Canada's interest rate cut at the beginning of the month. So let's look at this data to see where they're getting this narrative from, because I'm seeing the opposite. So here's a chart with the June sales going back to 2007. This is every June since 2007. And you can see very clearly we're at the same level of sales and the lowest number of sales since 2012. So 12 years, we're seeing record low sales, and it's only the third lowest, or it is the third lowest sales on history since they've been recording. So not a great June by any means, over a decade low in sales. But again, things are perking up, I guess. Now looking at the sales to new listings ratio for June, the reds are June, the rest of the months are in blue. You can see 2022 was worse than this year, but in the 5 years that we have data for, this June is the second worst. So not great by any means, obviously better than 2022 after we took that big crash when they started raising rates. I think I said the same thing about May last month. And now moving on to the months of inventory. And you can see on this chart, we've inched down just a bit from 4.3 to 4.2 months. It'll be interesting to see how low it goes. Of course, we'll be making higher lows and inventory continues to climb. So into the fall and into the winter, it'll be interesting to see how this holds up and if we make all new highs again, which I'm sure we will. And now looking at all Junes back to 2009. Again, this is as far as the data goes back for this statistic. And we are the highest since 2019 or in 5 years. Of course, every year we're making new highs, it seems, for almost every month. So that's a good sign. We are trending in the right direction, like I just said. And here is the year over year price change for the national average price. And we are seeing another month with declines year over year. So this year is down 1.6% from June last year. That is 3 months in a row that we are seeing these declines now. Now on to the national average price, which declined 0.4% month over month from May to June, or $3,000. And it's sitting at $696,000, which is still way too high, down 1.6% year over year from last June, as previously stated, or $11,000, and down 14.7% from the peak in 2022, or $120,000. Now, keep in mind, we are in peak price season, so this will continue to decline into the fall. Now, I just wanted to add in a few other analysis tools and patterns here. Here is the mean line. And to put this into context, we are still way above where we need to be for a healthy reversion to the mean. But let's look at some numbers here. So if we revert to the mean by January 2025, that's down to 585,000. That's over $100,000 lower than we are now. And that's just hitting the mean line. So that's a good case scenario, or a best case scenario. And again, we are going to see price declines in the fall, late fall, and winter like we always do. And it will be interesting to see how far we go as the economy continues to weaken. I've touched on this in numerous previous videos, and we are in a bearish pennant. I did make some predictions. We have not made a new high from last year. And again, last year, the new high was in May or June. We've just passed June and we've seen declines already. So we're going to be declining into the summer. If we break through the bottom of that bearish pennant, it's a very bearish sign and we will see some significant price declines. But again, this is not unexpected. And unlike stocks where seasonality doesn't affect them as much, real estate, we can confirm, like, we're going to see price declines in the summer, and we're probably going to see it break through the bottom of that bearish pennant. Some people say you can't use this type of analysis on real estate. Well, I say it's actually more accurate because you can predict with seasonality coming forward, which I've already done in previous videos. Here's a very interesting chart. I've done something like this before, but this is comparing the correlation between the average residential sale price, the national price in Canada, and the months of supply. You can see there is a lot of inverse correlation there. I'm going to break it down into sections now in a second, but you can see as inventory, when it's high, prices remain stable or lower. And as soon as inventory drops like it did in 2020, you see that red line dip way down, prices took off. And of course it reverses, the other ones reverse too. But let's look at this in sections here. Starting from the left, you see we are at healthy months of inventory, 6 months or so from 2010 to 2014 or so, 2015. And you can see we had moderate price or normal price increases year over year that would go with inflation. Healthy market, lots of inventory, and again, modest year over year increases. Then the second oval from the left there, you'll see around 2016, it was actually 2015. As the inventory starts to decline, the price increases get a little bit more aggressive. But then in 2018 or so, the inventory starts to pick back up. Of course, we had some interest rate hikes around that time, so that affected the market. But regardless, inventory increased and prices leveled off, and there was no significant increases in the prices, which was a good sign for the market, a healthy market. And then you get to 2020. I did leave a gap in the chart there of months of inventory because not including April and May of 2020 when the pandemic started, because that's just unreasonable because there was a big spike and we all know why. But regardless, the overall trend there is shown. Months of inventory goes down significantly as buying activity picks up, prices pick up, and of course we could not keep enough inventory because of the flurry of buying, and that's what happens with prices. But then right after the last circle on the right, as soon as they started to hike rates, People stopped buying, sales dropped, inventory increased, and we're getting more normalized with inventory. Our inventory is still well below where it needs to be, but as soon as that catches up, you know what's going to happen with those prices. They're probably going to cross back over, which I'm going to show you right now. So here it is broken down into two time periods. This is like, before the dinosaurs and after the dinosaurs. It's crazy. And it's clear. Now, the way this chart is set up, yes, it kind of outlines it in a very easy way to see. But you can see months of inventory is healthy and price increases are reasonably healthy. They did take off a little too much in that first big oval there. But the chart actually does what could be considered a death cross, where those lines cross. And now we are still below where we need to be, as I just mentioned. And of course, prices are still way above where they need to be. So how do we get those prices down? Yeah, you can build a bunch more homes, but that's not going to happen. Inventory is slowly increasing and people will flood, investors will flood their homes onto the market when times get tougher, and inventory will creep its way back up or shoot its way back up, one or the other, to 5, 6 months. And of course, supply and demand, prices will be down and they will remain down. It's going to be a long cycle, this one. And the last thing I want to talk about that's down in the real estate world are some real estate stocks. And these are some of the major players. These are for services. These are not REITs or property holders. They might hold some properties, but these are more for services and the companies that you would see in the real estate world. And I find these very interesting because they correlate with a lot of the spikes in the market and whatnot. First one here is Remax Holdings, Inc. And these are 10-year charts were allowed. Some of them don't go back 10 years because they're not 10 years old. But regardless, I went with a 10-year chart. And you can see Remax, it really spiked up in 2017. And the market was really hot in 2017. And in 2020, we had a nice spike there into 2021. And now look where they are. Lowest point in 10 years for these Remax real estate stocks. Moving on to Bridgemark, which is the parent company of Royal LePage. Again, after 2017, 2018, they reached their peak. 2020, they tanked until after they lifted restrictions and the market took off into 2021. They had a nice rally there. And again, 10-year low we're at right now for these real estate service stocks. This just confirms that there's not a lot of confidence in the real estate industry right now. And there was a lot of competition hit these companies, especially these two back in 2018. A lot of people flooded in. But then after the pandemic, confidence has been lost. It kind of looks like the average realtor's paychecks. A lot of these, they spiked in 2020, 2021. And of course, they've been declining since. Now moving on to a U.S. stock from Redfin. They have their hands in all sorts of services and holdings and whatever else they have down there. And of course, look at that spike in 2021. It's worse than the Canadian real estate market. And of course, they are at lower levels than they were in 2017 when this chart was first started, or when this company became public, I think it was. But yeah, lowest levels ever. Again, not a lot of confidence in the real estate industry and potentially market in the States either. On to EXP World Holdings. They've made big waves in the real estate market. They've opened up a lot of offices, especially in Canada. Lots of agents switching to this company. It's a kind of like a profit sharing system they have there. Maybe it's a pyramid thing. I don't know, but it is a profit sharing system. Big spikes again, 2021 and even into 2022. And they're not at all-time lows, but again, going back to 2018, they are near their all-time lows. So again, and it looks like they're going to have to wait for the next real estate bull market for their stock price to take off again. Now on to the last one, Open Door Technologies out of the States. It's a very interesting company, actually. They went public here in 2020, but this is a company, they have services, but they also do flipping, property flipping, and they hold properties. And you can like literally just book a showing the public and just open up the door and look at the house and buy it if you want to buy it. Look at their stock. They are pretty much ready to go bankrupt, this company. And again, they did spike in 2021 and 2022, but they are way below their initial offering of this stock when they released it back in 2020. And again, they're just hanging on here. And I don't think the market's going to come back and save them in the States. Things aren't looking too bright down there. So all these things are just a sign of where we expect the market to go, where I've called for the market to go based on the data. I'm just following the data here, and things are not going so well. Of course, unemployment is up. They are dropping rates, which is all part of the cycle. Rates are going to come down. They've already pre-planned them. They know they're going to drop the rates with the Bank of Canada next week, I think it is. Another quarter point thing, and the CPI came out today to kind of confirm that. I think they're 80% chances now. But again, they had that planned. They were going to do that anyway, unless there was some news that really told them, don't do this. This is not a good, like CPI went back over 3% or something. But again, the data doesn't lie, and let me know what you think in the comments. And until next week, I'll see you then.